my name's Alisha. I'm a new intern, and I'm here today to help you with all the big financial decisions that you have to make between medical school and residency. So, if you recently graduated and you're wondering, what the hell did I just take out? Stick around and I'll break down the basic types of loans that you might have borrowed. When you take out a student loan, the loan you get can be either federal or private. Federal loans come from the government. These are the loans that you get through your school after you fill out the FAFSA. Most people start with these loans first, and that's for good reason. They have lots of benefits. Typically, they have lower interest rates, they might be eligible through forgiveness programs, and there are more repayment options once you get out. If you need to borrow more money, and the bank of mom and dad isn't an option,
well, I'd like to help, but not as much as I'd like not to.
you may have taken out a private loan from a bank or other company. The terms of these loans can vary widely, and you'll need to look at your original loan agreement to find out what you signed. A quick note about these loans. Since they are private, they won't show up on sites like studentaid.gov or other federal sites, since the government doesn't necessarily know that you took them out. Alright, so moving into types of federal loans. Federal loans can be either subsidized or unsubsidized. Subsidized loans are great if you can get them, because the government won't charge you any interest during the time that you're in school or certain periods of non-payment like deferment. You might have some of these loans from your undergraduate education. However, they're not available to graduate students. Also, they're only available for students who have significant financial need. Unsubsidized loans are the much more common type of loan, especially for graduate students. This means that interest starts accruing immediately from the time that you take out the loan. When you take out a loan, any type of loan, the amount that you take out is called the principal.
It's the principle of the thing, sir. It's the principle. Principle!
Interest then accrues off of that principal. So, for example, let's say you take out a $100,000 loan with a 5% interest rate. Then you go into forbearance or some other period where you don't have to make payments for a year. At the end of that year, you now owe $5,000 in interest, in addition to the initial $100,000 you borrowed. I know, it sucks, right? But if you understand how interest works, you can set your payments up so that you pay the least amount of it as possible. In the example we just used, the interest is set at 5% for the entire time you're paying that loan. But in reality, your interest can be either fixed or variable. A fixed interest rate means that your interest rate won't change for the entire course of your loan. Any federal loans that you have will be fixed. A variable interest rate, on the other hand, means that your interest rate can change depending on the market at any time over the course of your loan. If you have private loans, these could be either variable or fixed. One more thing to note. Even though we often talk about interest accruing annually because it makes the math easier, you should know that you're really accruing interest on a daily basis. In the example we just used, where you had a $100,000 loan with a 5% interest rate, it's true that at the end of a year, you would owe $5,000 in interest. But that's not really what's happening. What's actually happening is you're accruing $13.70 of interest each day. Now, this difference might not seem like it matters to you right now, and that's fine. But as we start to get into more complex calculations and talk about things like capitalization, this difference is going to become more significant. So I know that's a lot of definitions, but before we get into more complex things like how to pick a payment plan, I just want to make sure that everybody understands exactly what we're talking about. I know a lot of this can be overwhelming, but congratulations on taking the first step and starting to understand your student loan debt. Going forward, I'll be making a bunch of videos on how to manage your loans and other financial questions that might affect you in residency. If this is something you would benefit from, be sure to hit the subscribe button below. Thank you so much for listening, and let me know what questions you have in the comments. Bye!